Welcome to the Deep Dive. We take comprehensive research and, well, turn it into actionable insight. Today, we are undertaking a pretty critical deep dive into the 2025 housing market outlook. And our focus is really sharp here, concentrating on the two variables that will likely determine market direction: inventory levels, and maybe most powerfully, interest rates.
That's absolutely right. And the material we're looking at today, it isn't just a forecast, It's more like a strategic snapshot.
Okay.
It's designed to help you, the listener, cut through all the noise and really get ahead of what looks like an incredibly dynamic year ahead. Our mission today is pretty simple, actually. Understand the core mechanism, how supply and financing interact, and then equip you with the specific tactical moves you might need to win, whether you're looking to buy, sell, or maybe even both.
Yeah, and the high-level view is interesting because you've got these two almost opposing forces. On one hand, finally some good news. Inventory is building up, which you'd think provides stability. But on the other hand, that 30-year fixed mortgage rate remains the absolute wild card. We really have to unpack the specific numbers, especially the impact if we dip below that, critical 6% threshold, because that seems to be where the market could really break loose.
Exactly. That 6% mark is key.
So let's kick things off with that foundational shift: inventory. The analysis confirms what a lot of people have been hoping for. Supply is finally increasing. The data suggests there are, and I'm quoting here, more homes for sale than we have seen in years. This isn't just a small bump, is it? Why is this change so fundamental to the market's tenor?
Well, it changes the entire psychology of the transaction. It really does. If you're a buyer, this means a massive improvement in selection, just more choice.
Right.
We're finally moving away from that really stressful scarcity mindset of the last couple of years where you felt like you were fighting 20 other offers over maybe the only two properties that even remotely worked.
Yeah, that was tough.
This rising inventory allows for better, more accurate, let's call it matchmaking between properties and genuinely qualified buyers.
Okay, but what about the sellers? Someone listening might be thinking, oh no, more competition means the market is weakening for me.
It's actually the opposite of weakness. It's really a movement toward clarity and predictability. If you're a seller, this stabilized inventory gives you a much clearer path to, well, pricing with confidence and selling with speed. That's how the research puts it.
It's pricing with confidence.
Yeah, the market starts rewarding preparation and good execution, not just blind luck in a scarcity situation. You don't have to worry so much about that total scarcity factor. The sales environment becomes more rational, which actually allows for better strategic planning on the seller's side, too.
Okay, so inventory provides a more stable foundation, a clearer picture. But the analysis we looked at really hammers home the point that mortgage rates are the, quote, biggest demand throttle in residential real estate. Rates are the core lever here, right? Capable of multiplying demand almost instantly. Could you walk us through that mechanism? How does a rate decrease suddenly inject so much demand?
Yeah, it's a dual effect, and both sides of it hit the buyer pool almost instantly and quite powerfully. First, there's the obvious one. The monthly payment drops for the exact same priced home. That improves simple affordability right away.
Makes sense.
But the second effect is the one that really triggers the market surge because it dramatically widens the pool of qualified buyers.
Because more people can suddenly meet their lender's requirements.
Exactly. More buyers suddenly meet those crucial debt-to-income ratios, DTI, that were previously locking them out.
Okay.
DTI, of course, is that figure lenders use to see how much of your monthly income goes to debt payments. Even a, seemingly small rate decrease can lower the projected monthly mortgage payment enough to squeeze thousands of people comfortably under that required DTI threshold.
Wow.
And that turns them from just window shoppers into active qualified participants almost overnight.
That distinction, affordability versus actual qualification, that's really key. And it leads us right to the absolute aha moment data point in the research we reviewed. What is the measurable impact if the 30-year fixed rate dips down to that critical 6% mark?
This is where the sheer kinetic energy of that financing lever becomes undeniable. The analysis projects that if the 30-year fixed rate dips to 6%, it's expected to instantly unlock, get this, roughly 550,000 additional buyers entering the market.
550,000 new qualified buyers.
Yeah.
To put that into perspective, I mean, that's like instantly adding the entire active home-seeking population of a huge metro area like an Atlanta or a Denver into the national housing queue all at once.
Pretty much. all looking to transact at roughly the same time. That creates immense psychological pressure, doesn't it?
It must. Wow.
It does. And the quantifiable impact totally backs up that psychological pressure. The NAR analysis cited suggests that this tidal wave of new qualified demand would be enough to drive national home sales up by about 13% year over year.
13%. A 13% jump in volume in a single year is, well, that's a phenomenal shift.
It really is.
It tells us that anyone currently sitting on the sidelines, maybe waiting for that rate drop, they need to seriously rethink their timing strategy.
Precisely. We rarely see a double-digit jump in sales volume like that, unless there's some kind of dramatic That's the exact friction sellers have to resolve right now. It's a good question. Waiting might mean potentially benefiting from a frenzy, that's true, but it also means waiting until everyone else who's been sitting on the fence also decides to list their home.
Right. More competition then, too.
Exactly. The real tactical advantage often comes from listing into that rising buyer pool, finding the sweet spot just as demand is accelerating, but before inventory truly floods the market from all the other waiting sellers.
Okay, listing into the wave, not after it crests.
Precisely. And this leads us to the 4 sort of strategic pieces of advice for sellers from the research. First, timing matters. You ideally want to list when that qualified buyer pool is accelerating. That increases your odds of multiple showings, stronger offers, compared to listing when selection hits its absolute peak saturation point later on.
Okay. What about pricing in this environment? Selection is improving. When scarcity was the rule, maybe you could afford to overprice a bit. Is that still true?
Absolutely not. That's a dangerous game now. And it brings us to the second and maybe most critical piece of advice. Pricing precision wins. When inventory was super low, sure, you could overprice and maybe still sell because buyers had 0 alternatives. But when selection gets better, an overpriced home just becomes the benchmark that makes properly priced homes look like a fantastic deal. If you overprice now, you risk just sitting there. And that stale listing history completely undercuts your negotiation leverage when that actual buyer surge hits.
Right. So presentation then becomes even more important to grab that early momentum.
It really does. That's our third point. Preparation pays. Focus on those light refreshes, definitely professional photography, and a really strong launch plan. This captures that crucial early momentum because buyers are kind of trained now to prioritize fresh, well-presented listings. And finally, remember that negotiation leverage can swing. As demand builds because rates are dropping, buyers tend to lose some of their confidence in asking for huge concessions. Days on market shorten up, and sellers generally gain firmer footing. Preparation allows you to capture that window of leverage.
That's really solid guidance for sellers. Okay, let's pivot. Let's look at the buyer side. If I'm a buyer right now and I'm hearing that potentially 550,000 competitors could suddenly appear, what should I be doing right now to try and secure a home before prices maybe accelerate again?
Yeah, for the buyer, it's really all about preemptive positioning and, frankly, mitigating future stress. You probably shouldn't wait for rates to actually hit 6% to start seriously shopping. Remember point 1, selection is better now.
Right, the inventory point.
Inventory is higher. That gives you options you just didn't have last year or the year before. You can actually take your time, find the right fit, not just any fit.
But the immediate challenge is still the higher rate today, isn't it? Compared to the potential lower rate maybe in 6 months. If I wait for the lower rate, I risk more competition, maybe higher prices. It's a catch-22.
It feels like one, doesn't it? And that's why the second piece of advice is act before price pressure returns. If rates ease dramatically, demand jumps, and yes, prices can follow pretty quickly. Getting pre-approved now, shopping now, it positions you to potentially lock in the home at a better price today before those 550,000 competitors join the game. You're basically separating the transaction price from the financing optimization.
Okay, separate the price from the financing. But if I buy now and rates are hovering at, let's say, 7%, I'm locking myself into a pretty high monthly payment. That's the source of the stress right now for many.
That's exactly why the strategy encourages you to, and I like this phrase from the research, own the monthly payment through strategic tools.
Own the payment.
You're encouraged to look into options like rate buy-downs or maybe negotiating seller credits towards closing costs or points, or just having a clear plan for future refinance strategies. A buy-down, just to clarify, is where you or the seller pays points up front to permanently or more often temporarily reduce the interest rate for the first year or two.
Oh,
It's a way to secure the asset, the price, the location you want today, and then you can optimize the payment later if rates continue to ease into 2025, maybe via a refinance. It helps mitigate that risk of buying high and financing high.
that's fantastic clarification. It really sounds like the key to reducing stress, whether you're buying or selling, is just removing the element of chance as much as possible. It's about having a structured, analytical game plan way ahead of time.
That is the ultimate conclusion from all the source material we looked at. Preparation essentially eliminates panic. The stress-free planning section outlines 4 core steps anyone can really start thinking about today. First, you need to develop a customized game plan based on your specific timing, your budget, your goals. This just turns an abstract goal like buy a house into a manageable checklist.
Right. And the second step really drives home the power of modeling that 6% number, doesn't it?
Yes, absolutely. You must run the scenarios. Model your potential monthly payment at today's current rate, then model it again at 6%, maybe even 5.75%. Visualizing how that rate move instantly changes your payment, maybe unlocks different properties or neighborhoods. That's essential for clarity. You need to know exactly how much payment flexibility you gain before the shift actually happens.
Okay, so once the scenarios are clear, then it's about execution. Optimizing the launch for sellers or the offer for buyers.
Correct. For sellers, that means maybe having staging ready to go, having a flexible pricing roadmap based on current comps. For buyers, it means being truly underwriting ready, not just pre-qualified. Having a defined touring strategy, knowing what your winning offer terms look like before you find the perfect place. That way you can submit quickly and cleanly when you find the right home, maybe before others have even finished their first showing.
Speed matters then. And finally, we have to talk about staying informed, but beyond just the national headlines, which are often delayed, right?
That's the last crucial step the research highlights. Track the signals. You absolutely must monitor weekly inventory changes, local rate moves if possible, and showing traffic within your specific zip code or target neighborhood.
Local data, not just national averages.
Precisely. This ensures your decisions are based on real data, not guesswork, as the source puts it. And it allows you to adjust your strategy quickly when those local conditions inevitably shift as we approach or if we cross that 6% threshold.
Okay, so let's try and summarize this comprehensive analysis. Inventory is up that provides needed stability, better selection for buyers.
Yep, foundationally better.
Rates remain the wild card. And that single move towards 6% is projected to unlock over 500,000 new buyers, potentially pushing sales volume up maybe 13%.
A huge potential shift.
So whether you plan to buy, sell, or both, the winners in this dynamic environment seem to be the people who prepare now, who model their scenarios, and who act with clarity and speed the moment financing improves.
That's the bottom line. Preparation, clarity, and speed.
I found it really compelling that the research specifically noted that the #1 way to make selling your home feel less stressful is simply planning ahead. It sounds like this entire strategy isn't just about maximizing profit necessarily, it's fundamentally about securing peace of mind through the process.
I think that's a huge part of it, yes. And if preparation and tracking those signals are the keys to winning, well, we have to think beyond just the widely reported national numbers, right? We know the 6% national average is kind of the trigger point we're watching, but local markets move so differently, sometimes ahead, sometimes behind. So if you're preparing to sell or buy, here's a thought to leave you with. What specific hyper-local indicator, something beyond just the overall inventory count for your city, should you start monitoring today? What local clue will ensure you are the one who acts quickly and with clarity when your specific market surge begins? Should you maybe monitor the average days on market for, say, 3-bedroom homes in your target zip code, or perhaps track the average number of showings per new listing each week? You need to find a metric, I think, that shows you the local competitive pressure before it actually shows up in the final reported sale price data weeks later.
That's an excellent challenge to leave with. Because knowledge is only really valuable when you know how to apply it precisely where you live. Start tracking those localized signals now. We really appreciate you joining us for this deep dive into the market outlook. We hope this roadmap helps you move forward with confidence.